You have questions, we have answers. This is Jane Miller.
And this is Ken Miller. Welcome to our show, all about real estate with Ken and Jane. So this past Wednesday, the Fed reduced the rate by 0.5 percentage point. So we got a lot of things to update everyone, our listeners, about the market. And we have with us as our guest today, Joe Urciuoli of Crown Home Mortgage. Joe, welcome to our show.
Oh, thank you, Kane and Jen.
Welcome back to our show, I should say.
That's right.
No, I appreciate it. I appreciate it giving me the opportunity to talk.
Well, this is a ripe time because we have a lot of, I think, encouraging news about the Fed's drop and the housing market and the mortgage rates go hand in hand. So we're going to talk about all that. But before we get started, just tell us briefly about yourself and the services Crown Home Mortgage provides.
Yeah, so we are a correspondent lender here in New Jersey. We specialize in home mortgages, 1 through 4 family homes, condominiums, townhouses. We do a little bit of mixed-use properties as well. We have a vast array of programs going from your conventional products to your first-time homebuyer FHA product. We do a lot of VA loans to help the veterans as well. So I'm personally licensed here in New Jersey, but we have an interstate lending group as well that we could do all across the country.
Oh, fantastic.
Great. All right. So a few days ago, this past Wednesday, there was some big news by the Fed, right?
Yes.
I think they weren't sure if it was going to be a 0.5 point or a 1/4 point. It turned out to be a 0.5 point. I guess the vote was not unanimous. There was one person on the committee that voted only to forward 1/4, but it is what it is. So it's a 0.5 point. So the first thing I was reading, some analysts are saying that the lenders may have already factored this rate cut into their portfolio for their rates. Do you think that's the case?
That's correct.
That
100% correct. Yeah. Most lenders across the board factored it in over the past month or so, where the rates went from 7 on a 30-year fixed to maybe 6% over the past 4 to 5 weeks. That was because they were getting ready for this reduction with the Fed fund rate. Because what they don't want to do is they don't want it to drop overnight and have that book of business locked in, and then they drop it by 0.5% because lenders across the board, there's a lot that goes on behind the scenes with that when that happens. Mm-hmm. So what they do is they trickle it over the course of months.
So
I was quite surprised, Joe, because I mean, I could be definitely wrong here, but I thought the market anticipated 1/4. Because I was shocked at the bold move by the Fed. First of all, I personally think they should reduce earlier. I mean, they would talk about reducing March. It didn't happen, but at least in July, they would definitely save the summer market because this summer is really slow. So because nobody knows they're going to reduce, not going to reduce, what they're going to do. But I was shocked by 0.5%. I know even a lot of talk before the announcement, but I feel if they dropped 1/4%, definitely priced in because last 2-3 weeks, you can see the rate drop so much. But 0.5%, perhaps, I'm hoping here, I mean, I'm praying there may be more drop in the interest rate for the buyers. Yeah. So because they dropped 1/2 rather than 1/4.
Well, the Fed is saying, they're insinuating that the rates could drop by a further 2% by the end of 2025, that's a tremendous amount of drop still built in, and maybe another drop by the end of this year.
Before the end of the year.
Which would help tremendously.
So, I mean, that's a lot. I mean, because there was never any indication in the prior Fed meetings. They were very cautious and just said, well, we're going to wait and see and look at the data and see how inflation is doing. But I guess they were encouraged that inflation is coming close to that 2%. Getting better.
I think it's not only inflation, right, Ken? It's the employment market, right? Third, correction. That's huge. Can you imagine?
Yeah.
3%. I understand. It's almost 30% or something. That's really that's huge.
Yeah.
So that's like maybe that forced the Fed to relook at the whole picture.
Yeah.
Because they didn't drop in July or earlier because the data, right? If somehow the data doesn't matter what happened, how it happened, it is wrong, and they have to react according to the revised data.
Of course, that's why they always
say.
So
that's why the 0.5% is
just to put it in perspective. Right now, your 30-year fixed is sitting right around that 6%, 6.15. In early May, you were at 7.25,
Yeah.
and last October we were at 7.8.
Yeah, very
So-
high.
Oh, wow.
Yeah.
Last
So
year,
it's almost 2 points in the last year.
yeah.
So that's a big,
It's
and that's a
huge.
huge. I think we discussed on previous shows that if you drop 2 points, it's all about the monthly payments when you're
Yes.
buying a
Correct.
house. That's what
Yeah.
people care about. So that's a huge. So that could be a good sign for the economy, because if they can reduce the monthly payment, that can help them afford the car lease and use that money, and it's like a win-win for the whole stimulus of the economy.
Exactly.
Yeah.
Exactly.
that's good. That's good
So
news.
it was a positive
Yeah.
outlook yesterday.
Yeah.
That was great. I know it's the federal fund rate, and I know
Yeah.
that's the rate that the banks lend amongst each other overnight,
Mm-hmm.
and it doesn't have a direct correlation to interest rates,
Yes.
mortgage interest rates, but it does have a contributing factor.
Yes.
Right. So how do you see rates? I mean, nobody has a crystal ball, but I mean, if the Fed might lower the rate again one more time, how do you see the interest rates for the consumer panning out? Because now we're almost through September. So in the next 3 months, I mean, you guys see that the lenders are going to maybe carve in a little more reduction, or they think it's hard to.
It's hard to say. I do have a lot of industry experts that I listen to, and they're saying right now, let your pipeline float, because the rates might trickle down even a little bit more. So I'm hoping, and throw in the fact that you have the presidential election, that election doesn't have a direct impact on rates, but it always seems to, every 4 years when we have an election, that it does help the interest rates a little bit. So I'm thinking that if we can get these rates into maybe like the low to mid fives over the next couple of months, I think that would be huge.
That's a win-win.
Yeah.
Yeah.
I
Just
think
like
traditionally, Ken, the winter, the rate, the supply and demand, winter and rate seems a little bit better. In spring, the demand pick it up, the rate go up. So that's why we just had a point reduction, possibly another one cut at the end of the year, and then it's the election, and then it's the winter. So I think for the buyer, looking good here, right?
Yeah, maybe this winter will be.
They'll be
nice.
good. Yeah, they'll be a good. As Ken said, that's a huge impact on the affordability.
Absolutely.
It's a huge. Yeah, that's really.
Points is huge, probably on a $300,000-$400,000 loan. We don't have the figure, but it's just.
Just to give you an example, on a refinance I'm doing for a customer right now, I'm saving her $250 a month. She was at like 7.5, and I'm doing her at 5.99 right now. It's huge.
Huge.
$250 per month on the mortgage
Joe,
is a huge
did you give
drop.
your phone number? I don't think in your intro. Did you give your phone number in case anybody?
I didn't.
That's so. Please go ahead.
It's a 908-307-2374. Again, it's Joe Urciuoli. I'm from Crown Home Mortgage.
Okay,
And
great.
if you guys are listening, if you want to refinance, call Joe, get a quote.
Yeah, or mortgage. And,
Or purchase.
we have to say from
purchase,
personal experience, Joe is always available, even on Friday nights, Saturdays. He'll get back to you. He may not text you right away if he's out to dinner with his wife and kids, but he will
Very rare,
respond to
very
you.
rare.
But he's very hardworking and very
try.
responsive and responsible, and he knows his stuff. So
Yeah, he always respond, even though he on the soccer field, he always get back to us.
yeah.
Yes,
Much
yes,
appreciated.
Yes,
I
yes,
appreciate
yeah.
yeah.
Yeah, so that's really good stuff. And I think the housing market there, the supply, the inventory is increasing too. So that means there's more opportunity for the buyers, more
Correct.
buyers out there to find a home. And
Exactly. They're not stepping over each other right now. If inventory grows a little bit, that's going to help. Along with the interest rates coming down a little bit, it's huge opportunity.
Right.
I think
buyers.
furthermore, it's like last 2 years inventory is so tight.
Yeah.
Partially is a lot of people. They had a 2.5% or 3%, and if they want to trade up, and then they have to pay more interest to give up what I have and a very low inventory. So those people didn't want to sell.
Correct.
So now there'll be good opportunity for them, because if they can get 5 or even high 4, that will be really, they'll be win-win, so that will create a more liquidity in the market. I wouldn't say more availability, because if these people trade up, it's like a 1 against 1 is equal, right? So cross it out. So I would think a liquidity in the market in terms of inventory, that would be a great help too.
Absolutely.
Yeah.
I'm finding families are growing, and the ones that are selling now just need a bigger home. That's basically what it is. They need a bigger home right now. So, like I said, the more opportunity would be out there if we have more inventory. So that would be a huge
And
plus.
also, a lot of people in the past they may think like add-on, but now because inflation, the material and the labor cost, so maybe it's more make financial sense and to just buy one rather than just to renovate or do the extension too.
Absolutely.
Yeah.
Yeah, and with the way the home prices in Central Jersey have gone up, I mean, that's a big factor with the reduction, the interest rate deduction, because it's just a huge savings to the monthly savings to the buyers.
Yeah.
I think a lot of people during the COVID last 4 years, they bought a house quick. They have to fight, no time to think.
Correct.
And buyer remorse, right?
Yeah.
Now they have a more cool head, so they can think about it. The interest rate is more affordable, and the liquidity of inventory is available, more home to choose from. Maybe it's a time for them to
100%.
to buy another house,
That
to
was
trade in.
that was a fast-paced COVID era. People were acting fast. Yeah, it was.
Yeah. So there's a lot of moving part at the
A lot.
moment. A lot of opportunity for the seller, for the buyer, for the mortgage company, for the real estate agent. So that's a win-win-win-win situation.
Have you seen your phone start ringing more so now in the last few weeks with the anticipation? Because we all realized that the summer was slow, the inventory was
Very
down.
slow.
You were saying before this show started that the summer, I mean, it wasn't just as much business being written because of the rates, understandably being as high as they are. But are you seeing that loosen up a little? And
Absolutely, yeah. In the summer months, literally end of June, up until the weekend of Labor Day. It was very slow because everybody goes away. You have buyers going away. You have real estate agents going away. You have loan officers going away. It was very slow. Once the kids got back into school, my phone started ringing Labor Day weekend. I was at a barbecue and the phone was ringing, and I have to work. And since then, it's been nonstop. So businesses have been very good since Labor Day weekend.
I think the rate has been going down since the Labor Day weekend too.
100%,
So that's really helped because during the summer the rate is really high. With the talking about the rate cut from last year December, so never cut it. So but the rate already reflect that when it didn't happen, they went back up.
Yes.
So that's why it's a holiday. Why a lot of real estate agents go holiday? Because no business. What are they gonna do in the house, right? They're going. So that's really was really a terrible summer this time from June till the end of August. Like June 15th, suddenly the whole world stopped.
Yes.
My phone just doesn't ring after check a few times. Is the phone working,
Yes.
right? But now it's all good. It's all good.
Yeah.
And I'm still finding that nobody could take that vacation during the COVID era. So people are doing it now. So as soon as that weather warmed up and the kids were out of school, everybody took off.
And boy, did it warm up. And it warmed up and we go back to July. Yeah. All right, very good. Why don't we take a short break? We'll be right back after these messages. Okay, welcome back to our show. We're joined today with Joe Urciuoli of Crown Home Mortgage. And Joe, once again, please give your contact phone number.
Yeah, absolutely. It's 908-307-2374. That's my direct cell number. You could either call, text, or shoot me an email at jurciuoli@crownhm.com.
All right, now
Fantastic.
we're going to test if you know how to spell the last name with all those syllables. That's kind of
Silent U in
I
there.
have a hard time. Urciuoli. I mean, that's a tongue twister too.
Urciuoli.
Urciuoli. I still can't. So now we spoke about all the good news with interest rates going down, and there's a downward trend. So a lot of buyers, a lot of people out there might be listening and thinking, "Gee, I'm a renter now. The rates are low." I always hear talk about like, "Gee, why not buy when you instead of renting if the numbers work out the monthly payments?" So roughly, what does it take? And again, this is all general advice, and every case is specific to the person. But what does it take for somebody to qualify for a mortgage in terms of how many years employment you need, and what kind of credit score, and just the
absolutely.
nuts and bolts?
So credit score, well, I'll start with, it's literally three pieces of a puzzle. It's credit, job and income, and assets. You need all three. You definitely need all three. So we go down to a 580 score. We don't love the 580 score, but we will go down to a 580 score. The higher the credit score, the better the interest rate. Second piece is the job and income. We want to make sure that you have a job for the ability to repay the loan back. That's very crucial. It's very important. You could have fixed income, you can have pension, you can have Social Security. And then the last piece is are the assets. Assets are important because you can get in to a single-family home with as little as 3% down. Most folks like to put down 5% or more. Obviously, if you put 20% down, you get even a better rate, and there's no mortgage insurance. So yeah, those are the three components to getting the mortgage. Like I said, you have to have all three. Some people will call me that are currently renting. You mentioned renters, and I love that. I love renters because you don't want to have to pay somebody else's mortgage. So they'll call me up. We'll go over the three pieces of the puzzle. I talk to them. I always kid around with them and say by the time I'm done with this, it's usually about a 42-minute first-time home buyer call that you'll know more information than real estate agents. I always kid
That's
around.
right.
I always kid around.
That's true.
So, but renters can definitely do it. Most renters think they can't do it. But if they have decent credit, a job, and some assets, they can definitely do it.
Now, do they need the job for a particular length of time, like 2 years, or is there any criteria? Or if they have a good job, let's say out of college, and they're making, let's say, 6 figures or a decent income, can they qualify for a mortgage based on like a year or less of employment history?
So if they're right out of college and their degree is associated somewhat with the job that they have in hand right now, we could use that history in college with the college degree with their current salary. So yes, they don't have to be on the job for 2 years. So let's say they were in college for 4 years. They got a degree in social work, and they are currently now on their job for 1 year as a social worker. We could use their current salary, and then we'll use the history of the college.
Yeah.
Which is a huge plus, and most people don't realize that. We do like a 2-year work history, we do, but you could switch jobs as long as when you switch jobs, you're not downgrading to a lower salary, because if you do, then we have to qualify you based on a lower salary. And sometimes if you're already pre-approved, that pre-approval might change now.
Right.
Yeah. For the listener out there, if you are on some special occupation like the police force or VA or a doctor or medical professional,
And teachers.
they always have, and the teachers, sorry, they have a very special program.
Yes.
And talk to Joe, talk to your lender, to get case by case. We just talk in general here, but you do have to, before you're thinking about buying, you need the professional advice. So you know what you can afford, and then you can find a home accordingly. And another experience that I had is a lot of time, right, when people have overtime or bonuses, right, even though you got the money, but you still have to talk to Joe, like a loan officer, to go through your financials, okay, to make sure that's counted, because how many times down to the wire they couldn't close. Why? They're waiting for this year's bonus because they can't, so you have to talk to loan officer up front. You have to give all your financial paperwork. And so in that case, you don't have a last minute crunch, right? So do your homework. Just that's basically, yeah.
I couldn't agree with you more, Jane, and I appreciate you bringing that up, because I always like to give real life examples. This just happened yesterday. Pre-approval with a borrower, and he makes a ton of overtime. He started his job in September of 22. In order to use overtime, you have to take a 2-year average. So I asked him for his last pay stub in 22, last pay stub in 23, and his year-to-date pay stub. This way I could take the 2-year average. He made so much in overtime, but this year-to-date, it was gradually going down.
Yeah.
Okay.
And when I asked him why it's going down compared to the previous year, he told me that they basically cut it out and they no longer offer overtime. which means I can't even use that as income now.
Yes.
Oh, because you know that you have that knowledge, so you can no longer
Correct.
take the 2-year average because you know that it's eliminated. So in fairness to the
eliminated.
lender, you have to
Correct.
discount it completely.
Correct. Now that's the difference between qualifying them on X as opposed to Y.
Yes.
So I could have easily counted that, and I would have found out while it's in processing when we did a verification with the employer that over
Last
time
minute, just before
Yeah.
you clear the
Or the underwriter would
commitment
have,
letter.
you caught it because you're very proactive, but the underwriters, and in some cases, if the loan officer isn't proactive, or they figure, well, I'll just push it through, then the underwriter finds out, then there's a big shock. And,
Correct.
and
Yeah,
then it
you can't clear the
you
loan.
can't clear the loan. And,
Yeah.
That's why there's some intricacies in my job where you have to ask the right question.
Yes.
Yeah.
And I guess a lot of it came with like through the years, you try to remember,
Sure.
almost like, court Smith versus Wade, that loan, you
Yeah.
did this instead of this. So yeah, absolutely.
So we spoke about the three pieces of the puzzle. Let's talk a little bit about the liabilities and how you look at the liabilities,
Yeah.
and let's talk about like car loans and
Sure.
and some things what not to do once you've obtained the pre-approval letter.
Yeah. So when I run credit, nowadays what we do is we run a soft pull of TransUnion up front, just so you're not directly impacting the credit report. We run the hard pull once the offer gets accepted. But we do the soft pull up front. We look at the liabilities. Most importantly, we look at the monthly payments. So if you have an auto lease, we have to count that no matter what. Even if you say, well, the lease is coming due in 3 months, it doesn't matter because we know that you're going to release another car. So we always have to count the auto lease. Financing of a car, we count that. If you're under a certain amount of payments, like for example, if you're under 10 payments on a automobile loan, sometimes we can exclude that from the payment itself. All revolving debt we have to count. We look at what the minimum score is. And nowadays, what's good with student loans is most student loans they do report to the credit bureaus, but they don't report a payment. If they don't report a payment, that usually means it's in deferment.
Okay.
We still have to count that against you, and there's a rule in place where we take the balance and we times it by 0.5% to dictate what the monthly payment's going to be towards debt ratio. Okay.
Okay, yeah. And what about the debt to equity ratio? There's a certain formula or certain ratio that you guys have as the benchmark.
Yeah. So for Fannie Mae, your conventional product, which is your cookie cutter product for most folks, we like to, we don't like to, but we can go up to 49.999. And what does that represent? It represents your total liabilities, monthly payment-wise, plus your proposed mortgage with principal, interest, taxes, and insurance, divided by your gross monthly income. And it can't exceed 49.9.
So
FHA will allow you to go to 56.5.
interesting. Okay.
The gross
And
income
that's-
is after tax or before
Before tax.
Before
Before
tax.
tax. Okay, so that's
yeah.
pretty
Before tax.
generous.
Yeah, that's pretty
So
generous.
different lenders
Yeah.
could have different. They could be more conservative if they want to be. But as
They want to be. They have their overlays where they sometimes
Yeah.
they
okay,
make
but
it-
roughly half
Yeah.
of your debt can be almost half of what your total gross income
gross
is, which
income.
isn't bad. Yeah.
Yeah.
And then there's one caveat to that, which is self-employed borrowers, we don't go off the gross income. We have to go off their net income,
Net income,
which is their line 31 on Schedule C after the
Okay.
write-offs. We can add back in a couple things like depreciation and whatnot, but for the most part, we have to take a 2-year average of their net income.
Wow.
Yeah.
If they're self-employed for 5 years or more, in most cases, we only need 1-year tax returns, so we don't need a 2-year average. We'll go off the last year's net income.
Wow, this was really informative, very informative.
Yeah.
We are out of time, but once again, Joe, we want to thank you for being our guest today, and please give your phone number again.
908-307-2374. And again, my email is jurciuoli@crownhm.com.
Thank you again, Joe. Please give Joe a call for any of your mortgage or refinancing needs. We'll see you next week. Have a great weekend.
Thank you.